Wall Street Week daily segment, the host of Wall Street Week, David Westin, joining us as he does every day around this time. And of course, the big headline today is all about that consumer price index report that we got this morning here. A lot of differing opinions about exactly what we learned.
Exactly. And as you know, Romaine, Larry Summers, the former Treasury Secretary, is a contributor to Wall Street Week. And so when he dropped by the studio this morning after the CPI numbers, we started out with exactly what they mean.
The Fed had things way off course. The Fed has corrected, and they're basically on course. But the plane is still well above the landing spot. It's still going very fast. And whether it's going to hit the ground hard, whether it's going to overshoot, is very much unclear from here. There is no sign in any of this that we have a 2% inflation economy now or in prospect. For all the happiness, the level of inflation that we're going to be forecasting for the year is well above what people forecast at the beginning of the year. So I think we've got still a difficult situation to manage. There are three possibilities. Soft landing, that's what we're all hoping for, and it certainly could happen. No landing, with inflation never really getting below 3% and potentially starting up again to rise when various things work through, or a harder landing as the monetary policy lags work through. And I think it's a very narrow window to achieve that soft landing. I'd put it at about 1 in 3 on each of those possibilities. And we're all hoping for the best, but there's no assurance at this point that that can be achieved. I think the Fed is right to be data dependent at this point. My best guess is that inflation is going to be a little strong and that they're going to need to move again sometime in this cycle. I think it's conceivable. It's not what I'd predict, but it's certainly possible that they'll have to move more than once. And the market, I think, is over-discounting that possibility. But it's a very difficult situation, and I think people need to be very careful about declaring victory and need to be very careful about some assets, particularly in the stock market, that may be priced a bit for perfection at this point, with more room for negative surprise than positive surprise.
We have a Fed meeting next week, and let's talk about that. Everybody seems to agree they're probably not going to raise next week. We will get a new set of statement of economic projections. What do you expect them to tell us about 2024? To continue your analogy with the plane, it's on track, but it's still too far above the runway. At the same time, if inflation's coming down with the policy they have right now, it becomes increasingly restrictive, right? Because real interest rates go up.
Yeah, I'd be surprised if they didn't slightly modify the front end to a bit less tightening, given that inflation's come down a bit, given that there are some indicators pointing towards slowing. I think I'd also hope that they're not overly signaling that rates are going to come down. You know, David, there's one fallacy a bit in the commentary. People, I think, are too facile to say inflation's going to come down, therefore real interest rates are going to go up, therefore the Fed is tightening. Here's the thing. Interest rates matter for the timing of spending. When you whether you borrow money to buy a car, whether you borrow money to buy a house. And so when there's going to be more inflation, you buy that car earlier, you buy that house earlier, you're more confident you're going to be able to repay. But the inflation that's coming down is inflation in services. It's inflation in indices about housing that are reflecting what happened 9 months ago. So I don't think that's anything that's really going to have much of a contractionary impulse for spending. So I think that argument pointing towards policy automatically moving towards restriction is a bit overdone. I think the argument that's underdone is the magnitude of the swing in the federal budget this year that we've had towards big expansion. I think Chairman Powell was not nearly as concerned as he should have been about the scale of fiscal stimulus in 2021, and I'd rather see him expressing more concern about the fiscal situation that we're headed into.
One of the things the Fed cannot control, as far as I can tell, is labor negotiations between the UAW on the one hand and the big three automakers in Detroit on the other. What do you make of that situation and what it really says about the state of the workforce and the state of technology, for that matter? Because, as you know, that's an important element in it.
We're all watching the UAW automobile industry nexus is less dominant for the whole economy than it was a generation ago, but it's still a big deal, and I think it's going to set a template for a lot of things. Here's the thing, David. I fear that there's a bit of an endgame dynamic going on here. Between the fact that electric vehicles take about 40% fewer workers per automobile, and the fact that a large part of the action in the automobile industry is moving to the southern part of our country, the UAW northern part of the industrial belt part of the country is going to shrink no matter what. And in that situation, the incentives for the union, like the incentives at one stage for the coal miners, like the incentives one stage for the steel workers, are to get as absolute much as they can while they can. And that, I think, is probably the underlying economic force behind some of the aggressiveness that we're seeing. And my guess is that this is going to be a difficult dynamic going forward for the economy.